Welcome back to another episode of the Kohrs Show, where it feels like every episode is getting a little bit spicier than the previous one, and that's mainly because everything going on in the world of the stock market, the economy, and even politics is all getting a little bit crazier. Today, we're going to be talking about how another bank is apparently on the edge of failure. We'll also be getting into how a billionaire Wall Street legend just took a pretty big hit from a new short report, and then finally, we're going to be getting into the insanity that will be tomorrow in the stock market because of Jerome Powell and the FOMC meeting, and really all the ridiculousness that is our central bank. So I hope you're buckled up. Don't forget to smash the like button, and obviously, let's ride. To kick things off, let's talk about the crossover event of the year. Bipartisan group including Gates and Ocasio-Cortez unveil bill to ban lawmakers from owning stocks. As I said, this is a pretty ridiculous duo. I don't think any of us had that on our bingo card for this particular year, but hey, I'll give them a round of applause for attempting at least to do the right thing. A bipartisan group of House lawmakers have unveiled a bill that would prohibit members of Congress from owning and trading individual stocks, a proposal aimed at restoring public trust by preventing lawmakers from profiting off insider information. In a sign that the measure enjoys support across the ideological spectrum, the bipartisan Restoring Faith in Government Act is sponsored by GOP reps Matt Gaetz and Brian Fitzpatrick and Democratic reps Alexandria Ocasio-Cortez and Raja Krishnamurthy. There's no way I'm gonna get that one. I'm sorry for butchering your name, but there's a couple too many letters. I truly do applaud their effort. This is something that I've been talking about for quite a while. I know it's something that you've been listening to for quite a while, but it is absolutely insane that our elected officials are able to trade in the stock market, even though they clearly are able to get information that is not yet publicly available. In any other profession, this would most likely be considered insider trading, but for whatever reason, we apparently allow our politicians to do it. Very quickly, the one thing that I want to point out here is how they're talking about individual stock trading. Now, this might sound good, and it does sound good, but I fear that this is a pretty evident loophole. If you look into any of the reports, you'll find out that our elected officials, you know, those people who kind of should be running our country and not sitting there YOLOing their entire account on Robinhood options, are doing exactly that. They are trading options. So if we come up with some sort of law that just stops them from trading stocks, I'm not hearing anyone talking about options. And I fear that this might be one of those things where it just sounds good of like, hey, I made a bill that turned into a law that stopped Congress people from trading stocks. And that sounds great. And it sounds like an obvious win, but what about options trading? So I just want to throw that out there that if this bill does become public and we can read it and we dive into it, see if it says anything about options trading, futures trading, and even crypto trading. The fact that members of the Progressive Caucus, the Freedom Caucus, the Bipartisan Problem Solvers Caucus, reflecting the entirety of the political spectrum, can find common ground on key issues like this should send a powerful message to America. I have to admit, it does send a powerful message, but what's going on that this isn't how things are already run? That's really what leaves me scratching my head. We must move forward on issues that unite us, including our firm belief that trust in government must be restored and that members of Congress, including their dependents, must be prohibited from trading in stocks, once again, not options, while they are serving in Congress and have access to sensitive inside information. This is basic common sense and basic integrity 101. I agree. It is basic sense. It is basic integrity. So why isn't it already this way? Speaking of ridiculous things, it appears as if the pain within the banking sector is not really close to being over. As a quick reminder, Silvergate, Signature, SVB, and FRC are all donezo, but apparently we aren't stopping there. PacWest and Western Alliance lead regional bank stock rut. First Republic Bank, ticker symbol FRC, was the most recent bank to collapse, and it also happens to be the second largest bank collapse ever, which is obviously still highlighting the frailties of the banking sector. PacWest and Western Alliance led the big sell-off in regional bank lenders today, Tuesday, as renewed fears over the health of the financial system hit Wall Street after the second largest US bank failure ever. We're talking in excess of $200 billion for one failure. Trading in both firms triggered multiple volatility halts after PacWest fell as much as 42%, while Western Alliance plunged 27%. The KBW Regional Banking Index dropped as much as 7%, the most since the crisis that engulfed Silicon Valley Bank in March. Now, I don't think this is that much of a big brain call out here, but it feels as if we're not really done with the banking crisis. Wall Street is wondering which bank could be the next one that needs a rescue, and that is making it easy to pick on other regional banks. It looks like JP Morgan's deal for FRC gave us just one day of calm for the banking sector. Regional banking stocks are still looking vulnerable until we can see clear signs that emergency lending programs can go away. Now, obviously, none of us have a crystal ball, but I would love to get your thoughts in a comment below related to the banking sector. Do you think everything's actually a-okay and this is being overstated, or do you think there's a bit more pain to be had? And if you're in the latter camp, I would love to know which banks you're particularly watching. While the banking sector story is obviously an important story that we should all be paying attention to, I want to let you know that there's a new story starting to develop that's causing some heads to turn because it involves a pretty down and dirty fight between a famed short research firm, Hindenburg Research, and a Wall Street legend by the name of Carl Icahn. Obviously, on one side of the fight, you have Hindenburg Research, which basically goes around and they look for companies that they believe to be overvalued for one reason or the other. And on the other side, you have the billionaire Icahn, who is considered by many to be a legend on Wall Street. Other people consider him to be a corporate raider, and I just consider him to be a very powerful and wealthy person that I really don't want to piss off that much because you never know, I might just disappear. Apparently, the employees at Hindenburg Research don't really care too much because this is what they just dropped today. Icahn Enterprises, the corporate raider throwing stones from his own glass house. I just want to let you know that this is a very lengthy and thorough research report, so I highly implore you to all do your own reading of it, but I just want to give you the TLDR. Icahn Enterprises, ticker symbol IEP, is an $18 billion market cap holding company run by corporate raider and activist investor Carl Icahn, who, along with his son Brett, own approximately 85% of the company. Hindenburg believes IEP units to be inflated to the tune of 75% or more. They think IEP trades at a 218% premium to NAV, vastly higher than their comparisons. They've uncovered clear evidence of inflated marks for IEP's less liquid assets, and IEP has suffered additional losses year to date following its most recent disclosure. Or to put that another way, overall, Hindenburg believes Icahn, a legend of Wall Street, has made the classic mistake of taking on too much leverage in the face of sustained losses, a combination that rarely ends well. Now, in all honesty, I have absolutely no clue who will win this fight, but if you caught the stream this morning, I was able to make some nice money off of the move, and this really doesn't take some big brain research. If you pay attention to whenever Hindenburg drops a report, generally, that stock takes a pretty gnarly hit on the day that it's dropped, and that's exactly what I did with IEP. At morning open, I bought some puts, the stock fell, and I made some money. C'est la vie. Let's move on to the next one. Switching up gears a little bit, I very much hope you're watching this before the market starts trading on Wednesday, May 3rd, and that's because it happens to be the date of the next FOMC meeting. We will get the results from the Fed members at 2 p.m. ET, and then the chairman of the Fed, Jerome Powell, will be speaking at 2:30. Very quickly, for those of you watching who maybe don't know what the Federal Open Market Committee meeting is or what it does, it's basically where a bunch of our central bank members decide what they want to do with the Fed fund rate. Do they want to push it up? Do they want to lower it down? Or do they want to keep it going sideways? And this has a massive impact on you individually, the overall economy, and even the stock market. In the short, medium, and long term, it can kind of prompt things to go a bit haywire. In fact, it's not that difficult to show how the Fed's decision, among other things to be fair, is what led to the recent downfall of some pretty sizable banks. So without getting too preachy, I hope you can understand the importance of this meeting and the decision because it could have a massive impact in many different ways, and it also explains why people are getting a little bit nervous as we are getting closer to the announcement. Speaking of which, at the time that I'm filming this, there's an 84% chance that we will get another rate hike of 25 bips, aka 0.25%, which will bring the running cumulative total to 5%. In all reality, this is pretty much already priced in. I mean, we all know that there's an 84% chance, so it's probably going to happen. But what we don't know is what Jerome Powell's going to say in his press conference that happens at 2:30. Is he going to be dovish? Is he going to be hawkish? Is he going to be leaning towards the fact that we're done with rate hikes? Is he going to be leaning towards the fact that we're going to get another 25 bips rate hike? That's really what everyone's listening for. What is Jerome Powell's tone going to be? What's his demeanor going to be? And is he going to hint at anything that gives us an indication of the next monetary policy steps? And for those of you who want to enjoy the chaos together, the amount as well break out the popcorn because I will be streaming the whole thing. What's that saying? Misery loves company. And now for you short-term DGen day traders, today was not a good day in the market. Well, it was if you were a bear, but overall, we could pretty much say it was a bloodbath. The overall market, the S&P 500 dropped over 1%, the Qs were down 0.9%, and as you can see, PacWest was down almost 28%, while Carl Icahn's IEP was down almost 20%. In fact, the only green thing on my watch list was Rumble, so shout out to everyone watching on Rumble right now. In terms of earnings, CVS reports before the market opens tomorrow, but really the major thing of tomorrow, once again, is that FOMC decision and the following announcement at 2:30 p.m. On Thursday, make sure you're paying attention to Apple because obviously as the biggest company, the biggest stock in the whole market, you're gonna have some sway, whether to the upside or the downside, so make sure you mark your calendars. As you can see here, it was a pretty rough day in terms of the S&P 500. We slashed through various levels of support, and gratefully, we were able to close above 410, but let's see how long it holds. If it doesn't hold tomorrow, I will be watching the 406 region. However, if we bounce and recapture 413, 414, I'll be then looking for the gap fill up to 415.27. For those of you who care about seasonality, I want you to know that tomorrow actually favors the bulls. Based on the past 25 years, tomorrow has favored the bulls only 48% of the time, so a little bit less than flipping a coin, but the profit factor is 1.7, as in every dollar spent has returned 71 cents on top of the initial dollar, and really the bullish trend started a couple years ago. Before that, it was pretty much flat and sideways. That's what I have for you today. I hope you enjoyed the video, and I truly appreciate your time. Don't forget to hit the like button, don't forget to subscribe, and I'll catch you in the next one.